Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, Scott, we're back at it again.
Yeah, another month in the books and off to a fairly good start for 2025 as far as markets go.
That's right. Markets are doing well. We've had a lot of client reviews. As you get into these new years, it's pretty common, to have our clients reach out and ask for an opportunity to sit down and for us to proactively reach out and sit down. And, you and I were talking recently about the quantity of meetings we've had between all of our advisors here. We've seen our clients well over 100 times in just this couple weeks, and that's been neat. And as we were kind of discussing as an investment committee some of the common themes that keep coming up, I just thought maybe today you and I could have a conversation about some of those themes that we're hearing from our clients in our early part of this 2025 calendar year, and questions and concerns that they've expressed. And maybe you and I can just have a dialogue on some of that.
Absolutely. Yep. So,
in the spirit of our kind of new format here, the psychology and the science of finance, we'll try to dive a little bit deeper into some of the topics, and then try to, make a little, more intuitive understanding, elementary level school understanding, and then maybe hopefully come up with some applications that people can walk away from and say, hey, I can plug that into my day-to-day routines.
Yep. Yeah, and that's where the rubber really meets the road. We want to, share good content, but then, kind of the therefore what, right? And we want to get to the therefore what.
Yeah. Everybody, wants to be educated and informed, but they also want to be able to take something away and say, I can use that. So some of the things that we get a lot of conversation about that I thought maybe, Scott, we could dive into first is 2025 did have a couple of changes to Social Security. Nothing overly significant, but people have asked about what they look like. So I thought, we could dive into that. So some of the changes we saw were the maximum taxable earnings on Social Security increased, went from 168 to 176. And probably spend just a second here. What that basically means is, how much money that you're earning is subject to paying against your Social Security tax. So the pool of Social Security money grows every year as current workers are adding to it. And if you make over that limit, then you stop contributing to that pool. And so every year they can just raise that limit to increase how much money they're contributing into that pool, and they do it. And I always laugh a little bit about this one because it's kind of a sleight of hand, right? Like they'll raise the cost of living on the Social Security benefits that they're giving you, but if they raise that by 3%, 4%, but then they take the maximum taxable earnings and increase that by 7 or 8%, it's just a kind of a magic trick, and they're still drawing the same amount of money back from us. It's almost like a backdoor tax.
Yeah, and it's interesting. There's a lot of levers that they can pull to increase revenue in those programs. Because right now, I think the last data I saw was the trust fund is funded through 2035.
Yeah.
And people look at that and say, "Wow, is Social Security going to be bankrupt at that time?" Under static assumptions, yes, but again, this is not like Social Security's first rodeo. In the 1980s,
Yep.
It was right on the brink of bankruptcy. That's where Social Security started getting taxed for the first time. And there's a lot of levers they can pull, be it increasing the full retirement age, increasing FICA withholdings. There's a number of levers the government has that they can pull to shore up Social Security.
That's right. And ironically, it was projected to go bankrupt within one calendar year, one fiscal year. And that's when they introduced the Social Security tax. And the thing that I always chuckle about is it was done under the Reagan administration.
Yeah.
And everybody, gets upset because they're like, he was the quintessential conservative, but he introduced a tax on our Social Security. So some of the other changes that might be a little more significant that we just saw, the windfall elimination provision and the government pension offset were retired this year. January 5th, they introduced the Social Security Fairness Act, which basically eliminated those two, and they were haircut programs, right? They were designed to say, okay, the theory was if you've worked for a public sector that didn't contribute to Social Security because you had a pension on the side, but you still were qualifying for Social Security for other reasons, a spouse benefit, or maybe you'd done some time in the private sector, they would still cut that benefit down, and sometimes somewhat significantly. And so now they've repealed that, and they've said we're going to restore the benefits. It's over 3.2 million people have had their benefits kind of fully restored, and I think going forward there'll be probably some planning opportunities here for people that had thought, okay, I don't think I'll have a reasonable Social Security because I worked for a municipality that had its own private pension, but now they'll have opportunities there.
Yeah, and there might be some planning opportunities that maybe weren't there previously. When we look at Social Security and Social Security planning, we look at both spouses, right? And it might be, hey, under the condition of the windfall elimination provision, our strategy or recommendation might be different than that having gone away.
Right.
And so to the extent people are impacted by that, it's worth revisiting and, making sure you're, pursuing the correct strategy.
Yeah, and Social Security is a pretty complex topic, and so we have pretty sophisticated planning software that we have to dive into with our people, obviously, and as we kind of work through scenarios and what if strategies and what if analysis, it gives people a little stronger confidence that they're not making a bad decision that becomes like an irrevocable bad decision.
Yeah.
Right. So we want to make sure that everybody's understanding that there are planning options here, right? With the GPO and WEP being retired. And then the last one is the cost of living on Social Security. It did go up, but it was a curious amount. What are your thoughts, Scott? It went up by 2.5%.
Yeah, it seems like a fairly modest increase relative to where inflation's been. And the interesting thing that we're seeing with inflation in particular is it's been resurgent as of the kind of last quarter of the year. So for much of 2024, inflation was fairly muted, but in the back half of the year, it started to surge again. And so that overall rise is reflective of the current year, of the full year,
Yeah.
but not the current trend.
Yeah, and that's concerning. It's the smallest COLA we've seen on the benefit in over 4 years now. And to your point, is it an accurate representation of the actual cost of living? And we'll have to talk about that a little bit. In fact, this next slide here addresses a little of those kind of trends that we're worried about.
Yeah, as we look at this chart, what we see is inflation crested in 2022, north of 9%. We all obviously felt the pain of that, and then it abated, somewhat. But the last 2 or 3 inflation prints we have had are quite a bit higher. The last one was in at 3%. The Federal Reserve's target is 2%. And then the other thing that's always important to underscore with inflation, when we say inflation has moderated or it's gone down, that doesn't mean prices are going down. They're going up less fast. So that's an important, I think, distinction to make with that. But
yeah, because I think people,
yeah,
anchor and they'll go, okay, when will my prices go back down? Because inflation's out of control. I should have my gallon of milk should go down again. And it's like, hey, the damage is done.
Yeah,
it's never going down. It's going up less fast.
Yeah. When we look at the compounding effect of the last several years as far as inflation, the average good is 20% higher today.
Yeah.
When you aggregate the compounding effect of inflation over time. One thing that's interesting is that's not uniform across all goods and services. Right?
So this is actually great. I thank you for that, because I ran like a little observation study recently, because I had a client reach out to me and say, okay, I want to run my retirement projections, and he wanted me to run his retirement projections at an 8% cost of living adjustment, like adjusting for spending at 8%, increasing every year. We talked about that. We said, hey, is that a realistic representation of what we're going to be up against over the next 30 years? And we talked about how that may not accurately, and represent that. And one of the things he said was, just look at the price of a gallon of milk today versus, 25 years ago. And I said, do you know the number? And he goes, well, no, I just remember what it was. And I said, okay, well, I don't either. So I went and pulled some of the numbers because I thought it was pretty interesting conversation. So Scott, the price of a gallon, this is as of 2024, the price of a gallon of milk in 2024 was $4.10. That was the price of a gallon of milk in 2024. If we go all the way back to the year 2000, so 25 years prior, the price of a gallon of milk was $2.78. So not counting for the compounding, but just the average annual increase was 1.63%. I thought that was interesting.
Yeah.
Because he had mentally anchored to the idea that a gallon of milk would have been, 15, 20 times that of what it was 25 years ago.
Yeah.
I think we all felt that pressure during the pandemic and post-pandemic. We all thought, oh my gosh, every time I go to Costco, my bill keeps going from $100 to $200 to $300.
Yeah.
And there was probably a lot to contribute to that. But when we look at some of these individual items, I thought this was interesting. A gallon of gas had a similar conversation. A gallon of gas in 2024 was $3.43 was the national average. And in 2000, $1.51.
Yeah.
So 3.48% was that, actual year-over-year average increase, which I thought was pretty interesting. There were some that were worse, right? For example, a pound of ground beef. Price per pound in 2024 was $5.60. Going back 25 years to the year 2000 was $1.56. That one is 5.47% year over year, and that's a much more painful reality.
It is. It is.
And so that might support this client's fear of an 8% inflation, because that's a 5.5% inflation on that specific good. But then you also see some that are deflationary. One I pulled was a 65-inch television set, and in the year 2000, any guess on what a 65-inch television set was in the year 2000?
That was a fortune back then.
Literal. Yeah. $10,000 price tag to buy a 65-inch television set, and you can go down to Costco today and pick one up for $500.
Yeah, pretty remarkable. And as we talk about inflation, we have to consider the power of compounding over time. I remember when I was a senior in high school, gas temporarily hit like 79 cents a gallon, right? And that was incredible. And I remember anecdotally my dad talking about a gallon of gas costing a nickel, right?
Yeah.
And you think back and you're like, boy, inflation's just exploded. But when you do the math and look at the compounding, it shakes out. It checks out. Now, the challenge is goods and services don't rise uniformly in prices. Like you look at the cost of auto insurance over the past 5 years, and it has grown significantly.
Well, you're just saying that because all your kids became teenagers.
That's true.
No, I have the same problem.
Yeah.
It's like, wait a minute, we added one child to the policy, and it how much? 5x?
Yeah. Well, the auto one's interesting because there's a lot of factors. There's the litigation piece, right, where the cost of litigation has gone up over time. But then because inflation's been high, the cost of repairing a car has been higher.
Yeah.
And so you have this negative feedback loop where because inflation's high, the cost of fixing it becomes higher, and that pushes auto premiums up. And then there's probably some profit taking there by the insurance companies as well.
I think that's a huge one that maybe doesn't get enough attention. I think retailers and producers of goods and sellers of services all woke up to the idea that the American people were willing to pay the higher prices on things, and they said, cool, we'll raise our profits.
Yeah,
it's pretty wild, but I think we saw it kind of uniformly across the board, everybody willing to say, we'll raise our prices on the backs of pretty significant national crisis, and there were a lot of companies making a lot of money.
Yep.
So, as we talk about inflation, Scott, I'm curious, where else this kind of plays out. There's more debt today amongst retirees as a trend nationally than we've seen in decades. In fact, there's an article I read on this that talk about a financial strain as credit card debt is spiking amongst retirees. Now, we're not necessarily seeing this as much in our clients, but we are seeing, people coming to us and saying there's a lot more pressure today to be able to afford the goods and services than I used to have to deal with. So let's talk a little bit about what are some of the factors contributing to the rise in, people having to take on more debt. One that came to my mind was healthcare costs. So what are you seeing amongst, when you're talking to our clients, what are some of their concerns with rising healthcare costs, and how can we help mitigate that?
Yeah. So I think the concerns there are premiums go up, right? So it's not just the cost of care; it's like the actual premiums themselves,
Yes.
go up. And then the other thing we'll bump into occasionally is if we're doing things like Roth conversions, or there's a big withdrawal need out of qualified money, that can trigger some IRMA considerations where your Medicare premiums get more expensive. So
let's talk about that real quick, just because I'm not sure everybody understands what IRMA means. So, what is IRMA, and then we'll figure out how to help them understand how to help audience understand how to avoid that problem.
Yeah, so the way Medicare premiums work is they're indexed based on how much you make, and so to the extent you make more money, your Medicare premiums are higher. Just like any other government tax bracket, there's basically a tax bracket for Medicare premiums. So to the extent you make more money, your Medicare premiums are going to be higher.
Right, and they'll look at 2 years of income, and then they'll make a determination on what your premium will be, and that's what that IRMA penalty is. They'll raise your premium, your Medicare Part B premium, based on those wages. So we'll actually see people who will take a withdrawal to go buy a car out of a qualified plan, and then they have a Social Security flow through that turns into, we've raised their Social Security tax because their provisional income goes up and their Medicare premium goes up, and they're like, oh gosh, was there a more effective way to buy that car than taking a big distribution out of my 401k? The answer is usually yeah, there are more effective ways, and that's where we'd want to sit down and have a conversation, right? Because so you're right. So the increased costs are coming from premiums going up in healthcare expenses. Generally, that's one that has not tracked inflation.
Right.
The national averages are between 5% and 6% per year, and if inflation is tracking at 3%, this is double that number.
Yeah. Yeah, and then you just have the natural function too of when you get older, you're seeing physicians more, right? There's more diagnostic tests, there's more checkups, there's more medications, so just you have the confluence of healthcare costs are going up, and then also you're in the healthcare system more. So that has been a particular area that squeezed retirees.
Another, this I pulled from a study that was done, that talks about why retirees today are experiencing this, higher debt burden. And obviously inflation, the cost of living was just higher than they initially planned on. So this, is a reason why we would look at an inflationary pressure adjustment when we talk about a model and say 8% is probably way excessive, but 2% is probably not a good representation either.
Yeah.
We need to have a reasonable expectation of what this can do. Another, reality check for me when I saw this study was how concerned retirees are. 66% pointed specifically to healthcare costs and said this was very concerning to them, that, they're waking up to this notion that, hey, I'm going to go into retirement, I'm going to travel, I'm going to go see, Europe and do all these exciting things, because they budgeted mentally what their, living expenses would be. But like to your point, when you're 75, all of a sudden, your healthcare needs are going to change, and those costs may not have been appropriately accounted for.
Yeah. Yeah, and the whole conversation around the increased debt burden that we're seeing nationally among retirees, I think it's multifaceted. I think, things are costing more, and I think that's clearly playing into it. The other thing I've thought about is the COVID funds are finally exhausted,
Yeah.
right? You can look at national savings rates and overall balances and savings, and coming out of COVID, there was trillions of dollars, trillions with a T, in money in the banks, and credit card balances were relatively low, and we've seen those banking balances go down and kind of get closer to historical norms, and then we've seen debt rise and get back to historical norms.
Yeah. Equilibrium
Yeah.
kind of finds its way. So we talk to clients about application here. Another one is long-term care considerations, right? The cost of long-term care continues to rise, just like healthcare costs continue to rise. And so we talk about resolutions and what we can do. And one of the things that, we mention to clients regularly is, it's not inappropriate to investigate long-term care insurance as a potential solution, because that can kind of lock in our cost. And if we are worried that's a potential reality, rather than like dealing with the threat of rising costs over the next 30 years, kind of saying, okay, I can address that today in today's dollars.
Yeah.
I can put a premium out there and buy what I believe will cover my expenses in 20 years in today's dollars. So that's an option, is exploring long-term care insurance. Another resolution that I think is important, and this one's unpopular, right? This is like a hot take, unpopular opinion here, but it's, sitting down and monitoring your spending, budgeting out kind of what you believe your spending is going to be, and then actually like using a software program that can track that spending, bringing it into, a place where you and your spouse can examine that together and say, okay, let's look and see how much money we actually spent at Costco last month. Let's look and see how much money we actually spent for Christmas for the grandbabies last year. And my experience when I talk to clients about this is, you don't even have to change behavior to get better and more efficient at spending. You just have to monitor behavior, right? You can say, hey, look, we're gonna have an idea, we're gonna try to come up with reasonable numbers, and then we're gonna pull it in and see it. We can use there's all sorts of programs out there, right? And most of them are free. And we're gonna look at this spending, and once a month or so, we'll just examine how much money we spent eating out last month. We're not going to necessarily say, hey, no more eating out. We're just going to look at the number. And my experience has been, is people are willing to just engage the exercise of just monitoring, just looking, then like the natural byproduct, without even like a focused, concentrated effort, is people through awareness just start adjusting behavior slightly.
Yeah, I think that's right. And I think we are living in a little bit of a new normal, where we've just gone through a pretty severe inflationary cycle. Inflation does seem to be rising again.
Yeah.
And then when we look at the complex cocktail of tariffs, potentially declining energy costs, and a lot of other things down the pike, we could see higher inflation going forward.
Yep.
And so what might have worked in the past might not work in the future. Or in other words, when prices were 20% cheaper, maybe we could have gotten away with, being a little bit cavalier about, swiping the card and being fine. But with prices 20% higher and forecast to go higher from there, that may necessitate some behavioral adjustments.
Yeah. And so I get this question like, well, which program should I use? I mean, there's literally dozens of really, really good ones. And I, so this kind of reminded me of like, a couple of years ago, I decided I really wanted to like get better at golf, and I, me, Scott, I'm a hack. I play golf, a half a dozen times a year. It's fun. I'm just not very good at it, and I've never made a.
Hey, you have a hole in one though.
Pause here for like everyone's just recognition. You're exactly right. I got a hole in one. That's not hyperbole. I actually got a hole in one, but it was a fluke, and I hold that over Mason's head as often as I can, because he, as we know, is an avid golfer and spent his whole life and hasn't had what I had. So that's embarrassing. But no, I'm not great at golfing. I decided a couple of years ago I wanted to try to get better. So I went to a golf store, and my feeling was it's the clubs, right? And so I went to the golf store and I explained kind of my predicament. And I'm trying to improve and I want to buy. And specifically at the time, it was my short game. I'm like, I could get on the green in three, but then I'll do it three more to put the dang thing in. And so if I could like trim that portion, I could really trim off some strokes with relative ease. So I said, which of these putters? They had a wall of putters. So which of these putters would do that for me? Just 50 putters on the wall. Which one should I get? And she said, the putter that will work best for you is the one you practice the most with. And I really hated that answer, but it's the same concept with budgeting softwares. The one that's going to work best for you is the one that you buy and commit to use. There's really not like a, reason why one's better than the other. They're all pretty much the same. Anything that you commit to, even if it's like an Excel spreadsheet or pulling out a notebook and just journaling stuff, just monitoring it and looking at it is what we're looking for here. So let's talk a little bit, Scott. In the couple minutes we got left, we had a lot of questions about kind of ongoing market discussions. I thought it'd be helpful to just spend a minute, you and I, talking through that. So generally speaking, in spite of some of the stuff we've addressed now, markets have kind of been doing okay.
Yeah, markets have been, from COVID onward, markets have been incredibly resilient overall. And they've taken a punch. They took the COVID punch, they took the inflationary punch, and that's not to say they didn't decline during those time periods. Yeah. They did, but they have, largely recovered in most instances. So, these markets, can kind of take a licking and keep on ticking. A big driver of that has been corporate earnings. Corporations continue to do really strong in the earnings space, and so that's been a big driver of markets continuing to do well.
So give us kind of your 10,000 foot view of where our clients, are most anxious, and what are some things they can do to kind of make sure they're appropriately invested today, given today's current climate.
Yeah, the two biggest themes that I've been hearing from our clients are concerns about inflation and rising prices, hence our discussion today. The other one has been kind of global change and global upheaval. The world order that we've had, post World War II till present. Some of that is undergoing change, right? Yeah, and so how does that impact things like the value of the U.S. dollar and U.S. equity markets and global trade and all those types of things? And our response to that has been kind of twofold. One, very important to have investments in your portfolio that can keep up with and exceed inflation. Yeah. So that becomes a really important theme. Stocks historically are pretty good hedges against inflation because companies just raise their prices. Things like precious metals can have a minor role in your portfolio. Energy, in particular, typically does well in an inflationary environment. We have some data and research that we've looked at where energy often will lead the pack as far as performance in inflationary environments. So those are some good themes. The other one is, kind of a boring one like budgeting, but very true, and that's diversification. Yeah. And so over the past 6 years, 4 out of those 6 years, large size U.S. companies have led the pack.
Let's look at this. Yeah. So there's actually a chart. This is an absolute mess, but if we break it down, it's actually a really cool chart. So this is what they call the Callan chart, and so each of these little squares that are colored differently. If you look at the top line, you've got the years from 2015 to 2024, and then you go down column per column, and they break down each asset class, right? So every color has a different asset class, and then they'll show how those asset classes stack up by way of performance. The row on the top would be the top performers for those given calendar years, and then the row on the very bottom would be the bottom performers, and then everything in between would be the order in which they were performing at. So it's really interesting because if you just look at a color scheme, right, you just look at like at orange, that's emerging markets, right? Yeah. So you can see like in 2015, emerging markets would have been like the top performer, the very number one performer, and then you can see it kind of bounce around, but rarely ever will you see emerging markets appear back to back as the top performer, right? In fact, it's not uncommon, like the red one like the kind of the darker red is crimson colors, like real estate. You can actually see real estate kind of popping between top and bottom, middle, top, bottom, middle, top, bottom, middle, almost like there's like a trend to, how some of these asset classes will cycle through. So with that backdrop, now give us the understanding of.
No. So what we're looking at here is kind of market leadership over the past 20 years. And so for the first 14 years of this time period, large size US companies led the pack one time.
Yep.
So they went 1 for 14, right? Last 6 years, they've led the pack 4 out of this past 6 years.
So is this a new secular trend that we're up against, or what is this?
Yeah, so the fear is gravity eventually takes over and mean reversion takes over, and we could see large size US companies, we could see them struggle. Not those companies in general, but we're so top heavy right now with technology at the top of those indices, where being diversified really makes a lot of sense. Making sure you have things like international in your portfolio, making sure you're not sleeping on bonds, making sure there's small cap. You want to be really well diversified. The adage with investing is when your conviction is high, your diversification maybe can afford to be a little bit lower. When your conviction is low, you want to be super diversified. And with the complexity and the challenges that, globally and economically we're facing, this is a great time, in my opinion, to err on the side of being really well diversified. Yeah.
So, and I call it like popular fund, like trendy fund selection, right? Where people get into like trendy funds, and then they overcrowd a space, right? And then that will cause an overvaluation of that space. And especially in today's like modern platforms of how we buy investments, what you end up with is like a lot of funds that really are just a redundant holding position, right? Because everybody's trying to buy into the same Magnificent Seven. And so you can buy like 10 different funds and end up owning the same like top heavy positions in all 10 funds.
Yeah.
And so you just get this really overcrowded space. And then the fear would be, if we've got this overvaluation, we've put ourselves in a prime position for corrective territory.
Yeah.
So examining that through the lens of like a fiduciary to say, okay, like we know what we're actually looking at. We're not just picking popular funds, and like how to actually know what you own and why you own it, and then like diversify can go a really long way for somebody in retirement.
Yeah, absolutely. And, maybe just like a parting thought on this. Investing is very different from other areas of life that we engage in. And the example I like to use, think about sports. I'm a football fan. We had the Chiefs and the Eagles in the Super Bowl. If you're taking a bet as to whether or not one of those teams ends up in the Super Bowl again next year, I kind of want that action, right? Like in all likelihood, like one of those teams is good enough to be in the Super Bowl again. We don't necessarily see that dynamic with markets. Things will go from first to worst and back from worst to first.
Right.
And so just because something was the hot hand the previous year isn't necessarily indicative that momentum is going to continue.
Yeah, and I'll overlay on top of that, like this is like, a career of investing strategies here, and my overlay is when we talk about retirement principles, you have to like layer that above the investing concepts in general, because the retirement principle is, yes, we have to have an investment portfolio, we have to build that model for how we intend to invest these assets, but we got to spend that money. We got to figure out how to get that money back out, and that adds an additional layer of complexity. So we can't just chase the hot dot around, but we also have to say, what are we doing to build models to allow ourselves to spend down these assets in volatile markets? Because we can't afford to say, well, we're in a 2-year down cycle, and I have to sell my top 7 stocks at 30% losses in order to buy my next car. So that's where this concept of smart retirement becomes so vital, for our client success, is just having these bucketed strategies of gray bucket for spending, a green bucket for protected, a yellow bucket for defensive, and a red bucket for growth, and then having the ability to balance and reweight these different buckets appropriately so that we can afford to distribute our money given any market cycle that we're going to be living through, and diversify it appropriately, because we are going to be living through market cycles, and we can't afford to like take all of our money and put it in a coffee can and bury it out back because of the inflationary concepts we just talked about. We have to be invested. So like the need for us to like balance these two constructs of staying invested during volatility so we can keep up with the inflationary pressures that we're up against, but not run the risk of unnecessary risk in our portfolio investment. So it's tricky, but that's literally what our clients pay us to do for them.
Yep.
So good dialogue today, Scott. I think this has been fun. Let's do it again next month.
Sounds good.
Okay, thanks.